No, you don't. And I just want to one time just drill this into people's head. Everyone thinks that gold is too risky because, oh, it's up at these levels, up at these levels. Yeah, it keeps on going. And this is even as the central banks continue, and the big money continue to hoard it as a tier one asset. When the guys running the printing presses are the biggest buyers, this isn't speculation anymore. I've been saying this forever. These are the central banks. It's a signal. And when the smartest institutional money here in the United States flips from sellers, we've been net exporters, to buyers, we are net importers, you better be paying attention. A reset is coming. Bottom line, do not trust the government data to guide your moves in precious metals. Their incentive is to mislead, not protect you. I've been saying that forever. Misdirection, right? The government numbers, the CPI, the unemployment numbers, everything, it's all a lie. And you can see it. The biggest deal to me above all else is that the people here, the institutional money, are taking in billions and billions and billions and billions of dollars a month worth of gold and silver. They go from seller to buyer. If you're not paying attention, you're going to miss one of the greatest wealth transfers of all time. I believe that in my soul. I truly do. And, it's interesting too, as the comment that we always talk about that Doug Casey made famous, that gold is the only true asset that is not someone else's liability. Well, I'd like you people to understand that on the United States government balance sheet, gold is the only asset on the federal balance sheet that is not simultaneously a liability. In other words, gold is the only true asset that the U.S. owns free and clear, and they continue to buy it, and it's going to continue to go up. Well, it would be massive. It follows. It would add another layer to the things that we've been saying. So I've been talking about the expansion of the Shanghai Metals Exchange. Vince Lancy's been talking about that eloquently, whereby they're building vaults in multi-jurisdictional areas, starting with Hong Kong, which is finished, where you can take possession already of gold in Hong Kong through the exchange of the digital yuan.
Yeah.
Right. So in essence, you have all of these vaults. The one in Hong Kong right now, you can take digital yuan and immediately convert it into gold and take it away. You don't have to convert to dollars first. And their aspirations then are to build a series of multi-jurisdictional vaults. The next one is under construction right now in Saudi Arabia. That is very significant because remember, Saudi Arabia was partners in Mbridge. They were the fifth partner, which is the cross-border settlement system. So it's significant in many ways, symbolically as well, that the second vault is being built in Saudi Arabia. The theory would be Saudi Arabia could sell its oil to China for the digital yuan. The digital yuan could then be just like that, converted into gold in one of these vaults, whether it be in Hong Kong where you take it or leave it there safely stored, or in Saudi Arabia, or in any of the other multi-jurisdictional vaults that will be built from parts of Russia, from all throughout the Belt Road Initiative, all over the place. They're going to do that, and they will connect with the vaults that were just built in St. Petersburg, in Moscow, in Singapore, in Dubai. They'll all connect. It is the ability to settle things outside of the dollar, to settle in gold, any imbalances or all of it if you want. They're all going to connect. Now, what the repo, adding a repo layer on top of that is genius, actually, because what a repo is where I need liquidity and I have U.S. Treasuries and you're the bank. I'm going to give my treasuries to you. You're going to give me funding and I agree to buy those back from you at a premium at some point, but I need the money in order to take care of things today and tomorrow. So if you're able to do that and use gold instead of U.S. Treasuries, which is one of the reasons you're seeing all of these countries sell U.S. Treasuries to stockpile gold. This is why guys like Vince Lancy says 85% of the gold that the central banks are buying is not reported to the IMF. Why would you? Remember, we saw Saudi Arabia getting caught reporting gold or not reporting gold last year, and China, but they got caught by the import-export numbers. But in essence, you have gold which is outperforming the Treasury handily. It's doubled it over the last 25 years. It killed it last year by almost 10 times. It's killing it again this year. So when you talk about gold outperforming the Treasury but having no counterparty risk, it's almost a better vehicle than the Treasury if you have the rails of a Mbridge type platform that allows instant settlement in 7 seconds without the SWIFT interference at a 98% reduction in fees, where you can trade local currencies to do business with other BRICS countries and settle imbalances in gold through a multi-jurisdictional chain of vaults. Take that gold if you want, or let it store. And if you need a loan, in renminbi because you're going to trade with China and do whatever you want, and using gold as collateral, not only are you sidestepping the dollar, you're destroying the value of the U.S. Treasury. It is silent genius as far as I'm concerned. Yeah, and by the way, a warrant for people who don't really know, a warrant is basically just a delivery ticket. Give me my medal. Here's my warrant. And that's the point of lowering interest rates. The Fed says we're going to lower rates. Trump wants lower rates, but they're really only able to really affect the front end of the curve, the overnight lending rate. Now, they've been talking about the hidden third mandate of the Fed that really is never talked about, where they could, if they wanted to, start to affect the back end of the yield curve. I'll get to that in a moment. But in essence, if the 10-year Treasury is what we're focusing on here, if these countries don't want to hold our 10-year Treasury, they sell it. The price of the bond goes down. Prices of bonds and the interest rates are inverse of each other. In other words, if everyone is selling and the bonds are falling in value because no one's buying them, interest rates have to go higher and higher and higher to attract more buyers. Conversely, if everyone's buying the treasuries like they used to, everyone's buying and buying, the demand is so high, rates go down because the demand is so darn high for these treasuries that, rates are going to start to fall. They move inverse of each other. So if everyone is now usurping the treasury market, not only not buying them and actually selling them like we've seen, then the bond prices fall and the back end of the treasury curve rises. We've seen this recently in the UK, where they've lowered rates on the front end. That's all they're really able to do, the overnight lending rate. They've lowered them like 7 times, yet the back end of the bond market, the 30-year bond that they have, is at or near all-time highs. In other words, the bond market says, you think you're going to lower rates right now? I mean, look at it this way. Right now, core CPI inflation, Dunnigan, is at 3.1%. That's a lie. We know it's a lie. John Williams of Shadow Stats would tell us it's at an 8 to that. It's 11%. But let's just play by their numbers right now. They tell us it's 3.1%, right? So it's 110 basis points above their long-term target, right? And so when you talk about Trump wanting to see the yield go down as low as 2%, right? 2%, they want to lower it by 200 basis points. They'd like to see that come down. At what point do the institutional traders say, oh, so let me get this straight. You want me to buy a bond that is actually paying a real negative return, lower than the real stated rate of inflation, the CPI. Forget about the make-believe where we know it's much higher than that, but the number that you're actually quoting at 3.1%, the 10-year is at 4. You want to see the 10-year as close to 2 as possible. So you want me to lend you money for 10 years at a 2% return when inflation, by your own BS calculation, is at 3.1%. I'm getting a negative real return of 1.1% per year compounding. No, thank you. And that will just accelerate the rush into gold. And ultimately what happens is that all of the intentions of the Fed to lower the back end of the bond market, they can't control it, because by lowering the front end, it betrays their ultimate goal is for lower in rates and higher inflation. It doesn't work that way. If you're going to have high inflation, then you need to have higher rates above the stated rate of inflation to attract buyers of your treasury. So in essence, what one would expect, and we saw this last year. Remember, they lowered the front end by 100 basis points or 1%. What did the 10-year do? Went straight up commensurate. The bond market is an animal of its own and sees right through the fact that the Fed is cornered and trapped. Add on to this a repo market substitute that is pegged to gold, in essence, using gold as collateral. It's genius. And the rails that they are building, not only the Mbridge rail, which they've already connected the 11 Asian countries and the 5 Middle Eastern, just the 11 countries alone in Southeast Asia have double the population of the United States and already are China's #1 largest trading partner. 800 million people are trading. And then you add into it BRICS Pay, which people don't talk about enough. BRICS Pay is the B2B side. It's the retail side. They are now introducing it to the Belt Road Initiative. 75% of human population. They're rolling it out to everyone else except the U.S., the Euro, European Union, and the UK. Same thing with BRICS Bridge. So the BRICS Bridge, the Mbridge, that's central bank to central bank. BRICS Pay is retail. You're covering all of your bases, which is chipping away rapidly at the transactional status of the U.S. dollar. And then the reserve status is getting beaten over the head by things like this, which will only accelerate the demand for gold in lieu of the U.S. Treasury. In essence, if you don't see that things are massively changing, if you are stuck in this dollar-based, recency-biased, make-believe fairy tale where it always used to be, you add on to the fact that no one trusts us anymore, and we're going around the world sanctioning punitively tariffs, threatens, wars. We're at that point. The history books will talk about this point right now as, especially with the Genius Act implemented, as the beginning of something new. Don't know how it looks when it finishes, but I would say we are at that point right now where the table has been flipped almost completely over and things are going to start to change.